Hello, and welcome to another episode with me, 𝗙𝗙𝗀𝗀𝗧𝗏 from eToro. By far, the stock I get asked most about is Warner Brothers Discovery, so let's get into it. I got interested in the stock back when it was just Discovery Plus, and before the reverse Morris merger, or whatever it was called, but basically it merged with Warner Media. So you got one of the only profitable streaming platforms merging with an enormous pile of content, shows like Friends, Rick and Morty, Harry Potter, and movies like Lord of the Rings. Now, one of the main reasons that this stock is so down from when the merger originally happened, aside from potentially the share price being a bit too high at the actual point of IPO, the big reason is a bunch of AT&T shareholders ended up with, instead of getting paid because it was a reverse Morris merger, a bunch of AT&T shareholders that were used to a 2% dividend got a whole bunch of Warner Brothers Discovery stock. And understandably, these people were not so happy about holding on to a stock that is hard to financially understand, and then also on top of that doesn't have a dividend. So what I think happened was all of those people that were gifted shares as a result of the merger probably sold their stock very quickly. And then on top of that, you need, in order to push share prices up these days, it seems like you need the internet sleuths to be behind you. And what a lot of internet sleuths use as a barometer of whether a stock is doing good or bad is whether the share price is going up or down. And so once it's got this initial share price collapse, suddenly this stock is just labeled as a huge red flag. And what happens is after that share price goes down, then they start looking for reasons that the share price, that the stock is doing badly. Instead of allowing price to follow performance, they allow share price to follow due diligence. And so basically they decided that David Zaslav's doing a terrible job, it's got too much debt, and they didn't do any more research beyond that. However, even recently, after the share price declined, we are seeing a lot of share price volatility. It's jumping from $12 to $8 quite regularly and seemingly at random. However, there is a reason that this share price volatility is perhaps a lot less volatile than it seems. Usually, to calculate the value of an individual share, what we do is we multiply the amount of shares by the share price. So we take the share price, we multiply it by the number of shares, and voila, we got the value of the business, or as we like to call, the market capitalization for some reason. Now, I am going to be going somewhere with this, but I'm sorry for the very basic explanation, but imagine that you have $1 share, then you have 1 million shares, well then you have a market capitalization of $1 million, you've got $1 million company. Someone pointed out the absurdity of this the other day. A comedian went onto Trafalgar Square or whatever, and he sold one share of a company for $50, but because that company had something like 1 trillion shares, he then claimed that he had a $500 trillion company or whatever. So obviously this way of valuing any business is a little bit absurd, although we see it being used all the time. Constantly they say 500 billion pounds worth of market capitalization wiped off the S&P 500 on the media, and they just say that 500 billion has been lost. It's not really that case. I mean, the value of these businesses, the CEOs of these companies don't really think like that. All you need to get is that market capitalization is just one way of valuing the cost of a business. And it helps us put into context things like revenue and earnings. So if a company is earning £100,000 a year or £500,000 a year, well, if the market capitalization is $1 million, then we must prefer the one that is £500,000 per year, objectively, just based off that information. It also helps us from getting ripped off. When you find a company that has 100 times earnings, you've got to expect a lot from that company very, very shortly, and incredibly consistent performance in order for that to be worth paying 100 times the earnings. And potentially a lot of the times when you're being asked to pay 100 times earnings for something, or 1,000 times earnings in some cases, or sometimes a company doesn't even have earnings, when you're being asked to pay that, usually you're being ripped off. You're being sold something that doesn't actually have value, which happens all the time, and there's very little anyone can do to stop that, because it's very easy to create an idea and create a formula and an excuse for that idea to be hugely valuable. But just remember that a lot of people are making money selling you something that potentially has a lot less value than it actually does. And then on the inverse of that, a lot of times things appear very unvaluable, no one wants to touch them, but actually they have a lot of intrinsic value. Now, the problem with market capitalization and the examples I've given so far is if you have a company with $1 million market capitalization, what about if it also has $1 million in debt? Now, you can imagine a bank there that is owed that money. You can imagine it as an expense, but really this is money that after you bought the share, you are obliged to pay out of your earnings. The company's earnings are your earnings once you're a shareholder, and you are obliged to pay this money. So if you had two companies that were identical, but one had $1 million worth of debt, well, you'd look at it as the market capitalization is $1 and the debt is $1. It would also matter when that debt is due, because you could discount that dollar if it's due in 10 years time, and we could get into that, but this video will become way too long. I want to just stay focused on why the share price is not that volatile. Hopefully you get where I'm going at with this, but in case you don't, let me just grab the whiteboard here. Blue pen for Warner Brother Discovery. Warner Brother Discovery, it's going up and down so much lately, but let's say it's got a market cap of 20 billion, but if it's got debt of 40 billion, and remember this figure of 40 billion is a little bit absurd because some of that debt is due in 40, 60 years time, and there are interest payments. So this 40 billion is a figurative representation of what shareholders are paying in debt for the stock. If you want to know more about the notional payments and interest payments for Warner Brother Discovery, I have done a spreadsheet for that, but we're not going to be getting into that right now. So there you go, 20 billion in market capitalization and 40 billion in debt. Now, the bit that is being volatile is the $20 billion market capitalization. Other companies don't necessarily have this much debt, and that is a large amount of debt relative to Warner Brother Discovery's free cash flow, but not that large. It's very manageable for our existing amount of free cash flow to service that debt, especially as all of that debt is fixed at under 5% interest. So whatever happens to the world currency, in fact, it is actually, I'm getting ahead of myself again. But basically, when you're looking at share price volatility, I think a much more accurate figure is to go 20 billion plus 40 billion. And so if the market capitalization, which is potentially what you are currently using to value the stock, drops to 10 billion, well, then I'd say that the share price, the actual cost to shareholders, has only gone down from 60 billion to 50. So in a way, the shareholders actually own less of the stock than the creditors, but the creditors obviously don't get any protection, don't get any say in the actual day-to-day operations of the business. They just get protection in case of an event like insolvency. They get paid first. By the way, guys, this figure of adding the debt plus the market capitalization, you're also meant to add the cash as well. Basically, this is called the total enterprise value. So I think this is a reason for a lot of the rhetoric online, because the share price is being crazy volatile, but actually the true cost of the business is also that debt as well. So a lot of investors are going, Warner Brother Discovery is a scam, David Zaslav is destroying the business, but all the institutional investors are going, well, no, actually the cost of this business has gone from 70 billion to 60 billion to 50 billion. And also, by the way, in a lot of my earlier videos, this is how I think of the stock as well. But the beauty of debt is that it's a bit like share buybacks in a way. Over time, you're going to have less and less debt as part of your free cash flow. So your free cash flow is going to get bigger, your debt is going to get easier to service, and eventually this debt just isn't going to exist. And yet your free cash flow should be relatively the same. I can't believe we've talked all about this, but we haven't even gotten into James Gunn's Superman trailer. I'm really excited for this more hopeful DC universe, but we don't have time for it in this video. So the thing that you really need to do if you want to be rich as a Warner Brother Discovery investor, you've got to